It's going out there. It's August 4th. I'm Frank Curzio, host of Wall Street Unplugged podcast, where I break down headlines and tell you what's really moving these markets. I'll tell you a little story here. In 2020, almost every retail investor, research firm, economist, none of them saw the COVID crash coming. And this was even when COVID started hitting the U.S., which was January. We saw that everything was closing in mid-December through January into February in China. But COVID started spreading every place. And I was covering a lot of the research firms and what they were saying. Goldman Sachs said we're going to see a quick V-shaped recovery. COVID's only going to last one quarter, quick bounce back right away. Same was said for JP Morgan, Morgan Stanley, Citigroup, all of them positive. Hey, this is just a small bump in the road. We're going to be fine. But every economist out there was predicting a quick recovery. Nobody saw the market crashing. Nobody saw lockdowns coming. Even at the beginning, we'll never lock down. We'll never wear masks, which is fine. I love the fact if you try to go on YouTube or try to find, Fauci and everything that he said at the beginning. Again, nobody knew. I'm not putting that on him, but just the fact that you can't find that anymore, that they took those off the internet is pretty funny. We'll never be that. We'll never be. Even Cuomo, we're New York. We're going to be fine. We're strong. We survive anything. Now it's, again, locking down again with de Blasio, who's a fucking idiot. Anyway, I won't get into a rant on that. But nobody saw the lockdowns coming. Sure enough, never happened in the United States ever. A lot of people didn't see COVID spreading to every single state. And again, none of them thought this was more than a bump in the road. And that road was, hey, a long, straight, bullish for stocks. Bullish for stocks no matter what. Now, some may claim, hey, you know what, Frank? We did see a quick recovery. Well, it was quicker than I thought it'd be, but only because the government injected $10.5 trillion into the economy, which, again, nobody was forecasting, even in February. It was insane to think the Fed would inject even $1 trillion into the economy in February once the shit started to hit the fan. And what do we see in a credit crisis? At the end of the day, it was, $470 billion injected to save the world economy. No one thought the government would ever spend $1 trillion. No way. We're into $10.5 trillion. And what? At least another $1 trillion coming in infrastructure? It's going to continue. But we live in a different world now, right? Where everyone, Wall Street economists, believes that printing is great. It's awesome, and it carries almost no risk. What's the risk? We didn't see any risks from printing our way out of the markets collapsing, the world economy crashing in 2008, 2009, 2010. We didn't see. What do we see? There was no really negative effects. This time around, hey, we're going to shut everything down. We'll leave a couple of businesses open. We're going to shut everything down, lock down, stay in your home, you got to die, all this stuff, right? All this crazy stuff. Even though the death rate in America is pretty much on par for every year over the past 5 years, the same amount of people died every year. It's just they'll die from the flu, which we don't have the flu anymore, right? Flu disappeared. I wonder why. But this is not the flu. COVID's not the flu. You can't say that. They might not actually allow me to say that. This podcast may be suppressed. That's a different story. But we do live in a different world now. Where printing is fine. $10.5 trillion, we're fine. We're good. Don't worry about it. Keep printing. There's no risk. What are the risks so far? We haven't seen it. Probably seen them. We're definitely going to see them one day. But the point is, very few people saw this crash coming. And you know what? Something that I've learned over my career. When nobody sees it coming, that's when crashes happen in the stock market, right? Nobody expects it. You can look back to 2007, when the foundation started cracking housing. Nobody really saw it was coming. Yeah, the Big Short, you have a couple guys here and there, but 99.999% of people didn't see it coming. Even the investment banks who were highly leveraged did not realize how leveraged their partners were until later on in 2008. Believe me, they didn't know, or they wouldn't have got that insurance from AIG, knowing that AIG would never be able to pay it out. Talk about that in a second. Credit default swaps. They didn't really know the full extent to it. But in 2007, unemployment rate was still low. The markets are floating near all-time highs. What do we see? Record profits. People buying tons of shit, mostly on credit, but who cares? They were buying stuff, which is great for the economy. It's what we want to see. More people buying stuff. But when you look back, nobody, not the Fed, banks, nobody understood how much leverage was in the system. And that even includes, look, the Goldman Sachs, Morgan Stanley, JP Morgan's, again, they will leverage out the ass, but they didn't see the scope of it, where just a 5% pullback in home prices would crash not just the subprime market, which some of them saw. Okay, the subprime market's definitely fuck. Oh my God. It wasn't a subprime. That's not what happened. It was the leverage of those subprime loans. The massive leverage where all you needed was a 5% pullback in home prices, and you saw a massive crash of the entire world's economy. Since most of these banks were leveraged over 30 to 1. But when we look back, that crash, that collapse, surprised 99.9% of the world, including almost every analyst and economist. Even when we started pulling back, remember Kramer's on TV telling you to buy Bear Stearns. I'm not ripping him because he also told you to buy the FANGs 12 years ago, 15 years, even when I was working there, we talk about FANGs. So I'm not ripping them, but, people didn't really know, even people on the inside, to the full extent what was going on. Most analysts would tell you to buy the dip. Sell-side shops were upgrading stocks and reissue buy ratings on their favorite ideas. I felt even when we saw Lehman fail, right? We let Lehman fail, and the government was like, wow, this is cool. Okay, we could let someone fail. We're not going to bail out anyone. And the Fed and government still had no idea the scope of this massive leverage and this bubble. Because that quickly turned. Remember, the markets did okay when they first let Lehman fail. And afterwards, like, holy shit, Lehman's tied to every single thing. It's all tied together. And the market started to crash again. Then the investment banks, they finally got it. In March, April, May 2008, that's why they all turned to AIG for credit insurance, buying credit default swaps, and actually going short now, reversing their positions. Goldman is classic for this. Fully hedged. They own over $22 billion of these swaps, which actually bet against the failure of AIG as well. How awesome is that? That's fantastic. They're betting against AIG failing. You look at Wall Street, I tell you all the time. They'll throw their mother off a bridge if they know they can make a fortune off it. If you're laying there and you have a sock on, they are going to take that sock off of you and give you nothing. That's Wall Street. You have to realize who you're dealing with. But AIG, they had no fucking clue. They had no idea. Because even though the banks were short, AIG did not have trillions to back this bet. It was just like, hey, yeah, it's fine. Yeah, we don't see it coming. Fine. I remember the Fed, the government, when they found out AIG, wait a minute, AIG's involved? How's that possible? It was great. But it's like in The Big Short, if you read the book or saw the movie, sometimes you're too right to where the market crashed so much there was nothing left to get paid from your short positions. It's almost like suing an insurer, a small insurer, for $50 million and winning. That's awesome. High fives, everybody happy, lawyers, everybody getting paid. That's great until they go bankrupt and you get no money. Now, what happens? Nothing. Kind of the case of AIG. So where am I going with this? What's the history lesson for? Why am I boring you to death with this crap? Because on CNBC, this is on Monday or Tuesday, there was a story titled 20 Strategists Predict the Next Time and Size of Stock Market's Next Big Bubble. 20 strategists. Of course, you had to pay for it. It's funny that you have to pay for that, even though these are people that are going on CNBC and they're providing research, right? Goldman Sachs. So basically, CNBC is selling Goldman Sachs research to everybody else, which I think is funny. That's okay. That's fine. But the first thing I thought when I saw that headline is you should be long stocks. Because we're probably not going to see a crash come for a while. Why is that? The story, again, 20 strategies, the next time in size of stock market's next big bubble. Why? Because crashes don't come when everyone expects it. That's the one certainty. The one certainty that I can give you from my close to 30 years in the markets. They don't crash when everyone expects it. They happen when nobody expects it, when your guard is down. And the fact there's so many skeptics out there, including you, including me, including a lot of the public, right? That's usually a great thing for stocks. That's what you want to see. You want to see people nervous. You want to see people that they're not all in. The skeptical market's going to crash. That's a good thing for stocks. It's bad when the whole entire world is bullish and swinging to one end of the pendulum, because what happens? You're going to swing, and usually you swing a lot further than you ever think. Just like during the credit crisis, just like during COVID. We fell a lot more than what people thought before coming back. Now, you heard me warn about inflation a few months ago. Felt like I was early to the party. The inflation argument, that's probably the first time that I made that argument of something that really worried me in my career. I can't remember talking about inflation to where, runaway inflation could really crush the world economy. And why is that? Because it removes the safe haven of the Fed as a bailout option. So you have to print less money, stop buying bonds, or tighten. You have to tighten monetary policy to stop it. You almost have to force a recession. So it takes the Fed out of the equation. This isn't bailing out someone with money. Oh, whatever. JP Morgan was over leveraged and they're in trouble. Okay, well, we're going to backstop them and they're going to be fine. No, the Fed can't do anything when you see runaway inflation. They have to say it's transitory, because if they don't use that brilliant word transitory, which means we don't care if inflation goes forever, because it's going to be temporary. Even if it's like 6 months, a year, they're not telling you, right? 6 months, a year, 2 years. They're not telling you what transitory means. It's brilliant. It's a brilliant strategy to say transitory, because it allows them to keep the machine on without worrying about where inflation goes. Otherwise, if they didn't say it's transitory, what do they have to do? They have to tighten right away. Taper, whatever the word they want to use. They have to. They don't want to do that. They're not going to do that heading into midterm elections. Huge. No way. The Fed is a political body, no matter who it is. If it's Republicans, Democrats, it's a political body now. It's not separate. No way. When I was talking about inflation, very few people were talking about it back then. I remember getting emails saying, Fred, come on, inflation, look at the 10 years, not here. I'm like, man, don't you see the labor shortage out there? You see what's going on in the world? I mean, come on, you guys have to see it. But nobody was really predicting inflation, other than like the Dents and Schiffs, who were predicting massive inflation every year since they were like 12 years old. I'm not talking about those people. Just, they have an agenda. They're going to say, no matter what facts change, they're never going to change their opinion. This is what they believe. That's fine. People love following that, cults and stuff like that. That's good. You're going to lose a lot of money doing that, but I understand. I understand that people just follow cults and it needs to be told what to do. I understand that. I get it. Investing in anything outside of what those two guys told you to invest in over the last 10, 12 years, you would have made a fortune, and with them, you wouldn't have made anything. It's besides the point. But you look at inflationary market, to me, it was pretty obvious. Injecting $10.5 trillion into an economy in a way where it was going directly to consumers. It was a check going to, wasn't like the credit crisis. Well, let us backstop the banks. This way they make them look safe, and it'll be up to the banks to lend, and we have rules with the banks so they can lend and how much they can. No, this is, hey, just keep throwing the checks. Give it to them right in the bank account. Boom, 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 boom. And then what did you do? You open everything up at the same time. The economy's fine. We're good now. Everything's cool. And what are you going to see? You're going to see massive demand, massive shortages to build products. Makes sense. Which then leads to rising commodity prices, which leads to higher costs for businesses, which forces what? It forces them to raise prices. That's the definition of inflation. However, over the past 6 weeks or so, we've seen Dean Cooperman talk about inflation, warn about inflation. Ray Dalio, Druckenmiller, Gundlach, these guys are a lot smarter than me talking about inflation, making public statements that they're very, very, very worried about inflation. So for me, how do I look at that? Because now that everyone's talking about it in mainstream media, it's no longer a massive risk that nobody sees coming. Again, even the Fed, the past few meetings, talked mostly about inflation, how it's transitory and all that bullshit, right? That they're talking about it now. But again, markets don't crash from something that everyone is talking about. They crash when nobody expects it. When the public is totally confident, totally bullish, when they're all in, they can't go lower. And you know what? We don't have those conditions today. I mean, stories like the one I mentioned, CNBC, I see them all the time. I'm connected to everything, right? All these stories, people sending me stuff. Again, Bloomberg, if it's Thomson Reuters, if it's Wall Street Journal, you name the source. But I read this stuff all the time. Even in the newsletter industry, how the market's going to crash 50% next month. It's going to happen on September 7th. 50% crash. Be prepared. to buy these gold stocks, even though gold stocks tend to fall even more during crashes. But buy these gold stocks. You're going to make a fortune. I mean, they know fear sells, right? That's how they generate revenue. Tap into the emotions of people. Think about the media, the Delta variant. Is it spreading? Yes. Is it causing more hospital visits? Yes. Is it deadlier? No. Not even close. Not even close. Much less deadly than the original strain. Nobody cares. They're not going to tell you that. They're not going to tell you that few people are dying. They're going to say, hey, hotspot areas are here, hotspot areas are there. It's got to mandate masks now. And we'll talk about it later, but mandate in New York, first place to mandate that you need the vaccine to go indoors. Are you kidding me? You need to have the vaccine. You need it. Even though if you get the vaccine, you're safe. You're perfectly fine. But I need everybody else to have the vaccine. Everybody else must take it. I don't care if you believe in it. I don't care if you don't. I don't care if you got COVID already and you have antibodies in your system that obviously are lasting longer than antibodies in the vaccine, right? Since they're providing booster shots. But yet people with COVID already not really getting it. You see some few isolated cases and, I had COVID. I had the COVID shot. It wasn't, I don't know, it was McConnell, one of those Republican leaders. Got the vaccine and now I got COVID, and even said, he goes, it's very mild. Very mild. It's not bad. But still, it's not deadly. But why are they pushing this issue? Everyone take the vaccine. You got to go crazy. Their job is to scare the shit out of you. Because you watch more TV. They make more money from advertisers. Our politicians, makes all the sense in the world. They gain more power, more control. That's what they want. That's what every politician wants. We all know that by now. I don't care what side you're on. If there's one thing we could agree on with Democrats and Republicans here, is that the mask mandates that are going on right now, people are freaking fed up on both sides. That's the one thing we've come together. Enough of this crap. Enough of it. But it's all a system. And even in my world, right, when it comes to Wall Street, analysts and market pundits, right, every time they make a prediction, it's like, hey, I'm bullish on the markets. Almost every time someone says they're bullish on the markets, they have to follow it with the word but. We're going to see a market crash soon. I'm bullish up to next year, but I can see the market crashing soon. You know how many times I heard that over the past 10 years? Markets still near all-time highs. Not only is that a bullshit forecast, since analysts love to hedge themselves, like politicians these days, right? They're never going to admit that they were wrong. Say, hey, if the market crash, I told you it was going to crash. If the market goes high, I told you it was going to go higher. I said, yeah, later on, we're going to, to me, that's useless. It's useless. Absolutely useless. But hey, you make some crazy forecast. That's how you get on TV. That's what people want to see. They don't want to see you go on TV and say, hey, you know what? The markets are cool here. We're going to see a steady trajectory higher. Earnings are going to be pretty strong. They don't want to hear that. They want to hear either it's a 50% market crash or we're going to continue to hit new record highs going forward. It's going to be insane. That's what they want. That's what people want. People love to be entertained. That's how we're built. We need entertainment. If you have any doubt at that, just look wherever you are right now. If you're at wherever you're listening to this, maybe you listen to the car, so don't look. I don't want you to get into an accident. Everyone's on their phone. Everyone's on their phone everywhere. You walk to a mall, I'm not just talking about kids, even adults. Everybody's on their phone, even at dinner tables. Go eat dinner. Look at the couple. They're not even talking to each other. They're on the phone. Everyone's on the phone. They need to be entertained. Need to listen. I got to read stuff. I got to watch it. That's how we're programmed. That's fine. But it's almost like, as an analyst, you can't say you're bullish publicly without also using the word but, right? This market will overheat and eventually crash sometime in the future, right? That's the way it is. But here are the facts right now that you need to understand. Interest rates are at record lows. The Fed has no intention on raising them anytime soon, especially into midterm elections. No way. Corporate profits are at record highs. Surging. Look at the quarters these companies are reporting. You can't say, well, they're higher as a percentage. I'm not talking about higher as a percentage. I'm talking about, forget the percentages, the actual earnings. Holy shit. And some of these companies are killing it. Margins are accelerating, meaning these companies have incredible pricing power. And Facebook raising individual ad prices by 47% last quarter. 47%. And getting it. I've been in supermarkets lately. They're selling 12-pack case of Coca-Cola, canned soda for $7. One case. You could buy 3. You could buy 2 for $7.50, and then they give you 1 for free. $7. And you know what? People are buying that. They're buying them at that price. Corporate balance sheets have never been stronger. Wait till you see the amount of buybacks that are coming. Can't say, yeah, companies announced that they increased their buyback, instituted more buybacks, but a lot of this is going to happen after earnings season. They're in a quiet period. See companies buy back. You're going to see much more announcements going forward. What was it, Micron, first dividend ever. I mean, we got so much freaking money. Fuck it, let's just pay a dividend. It's crazy how strong these balance sheets are. You have our banks who used to allow massive leverage, were able to take on excess risk with their own balance sheets, generate profits. They can no longer do so. You have regulation, Dodd-Frank. You have the stress test to keep them in check. This regulation doesn't allow them to take on massive leverage anymore, so that helps avoid another credit crisis. Do we have a lot of leverage in the markets? Absolutely. But you have to put things in perspective. You can't talk about one side without talking about the other, because household wealth is at all-time highs. People have so much money. Now they're spending it on discretionary stuff, which we're seeing in the numbers. They are also paying down credit card debt and putting cash towards savings. Savings rate is at 9%. That's about 50% higher than the average savings rate over the last 20 years. I mean, you do not see that. You do not see that ever. When people are saving, that's bad for the economy. It means people are spending less, and if they're spending less, companies are generating fewer profits. No, they have so much money that's working. We're saving. We're paying credit card. Look at J.P. Morgan. I'm not making this stuff up. Just look at they were like to a surprise, which is a negative, that people are paying down their credit card debt. And they're saving more money. That was amazing to me. I don't remember seeing that. I don't remember seeing that in a bull market ever, with stocks at all-time highs. See, when you pull back, you want to be a little safer, put money in savings. No, they're doing everything. They got so much money. Hey, do whatever they want with it. You look at productivity through the roof. New technologies, faster internet, allow companies, people to produce much, much more in less time. That continues to get better and better. M&A near record highs. You have a good business model, you have a good idea, you almost certainly get funded. Especially you know the right people, you'll get funded. You have a company that was successful that you sold to somebody, especially in technology, biotech, or whatever, and you want to start a new company, you're getting funded. It's $30, $40, $50 million, like nothing. Like nothing. It was a company that was just bought by Blackstone, $900 million for Reese Witherspoon's company. By the way, some of the things that she's produced on HBO and little things, just so many great movies, series that I saw dedicated to women and stuff. Had Nicole Kidman. I mean, fantastic. Good for her. $900 million. Holy cow. $900 million. That's huge. You get funding anywhere. And as for the inflation argument, when you look at inflation during the early stages, it's great for the economy and businesses. That's what the Fed wants. Yes, it's getting ahead of itself, and it's a little scary. But it's much, 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 much better than deflation. As long as we don't see double-digit, crazy runaway inflation, we should be okay over the next few years. Then people say, well, what about the valuation argument? We're trading at 21 times forward earnings. That's a huge number. It is a huge number. I mean, the average over the past 5 years was 18 times. The average over the past 10 years was 16 times. However, you have to take everything. You can't just point out one stat. We have interest rates at near record lows. Record lows. And we're in a market where it was just flooded with money. Now we're opening up to the world. You're looking at a market where earnings are expected to grow north of 12% over the next 12 months, while sales are expected to grow north of 7%. That's probably 3x higher than the projected gains annually that we've seen over the last 10 years. I would say maybe 3-4% earnings have grown. Maybe a little bit more than that. 12%. At 12%, the S&P 500 earnings at that kind of growth rate, 21 times is not an expensive valuation. It's not. You can't say it's expensive. You also have interest rates, record lows. Again, they're going to stay there for a very, very long time, which is great for companies and borrowing. And then we got the million-pound gorilla, which is the Fed, who will refuse to let our markets even correct a little bit without throwing tens of billions into the economy almost immediately, whether it's buying bonds, extending benefits from the government. And you look at fiscal and monetary policy. But on the monetary side with the Fed, it's, keep interest rates low, keep buying bonds. Why? Record profits, GDP back to normal. And we have a clear runway of our growth right now. Unemployment is low. It's probably not going to go any lower because they continue to get benefits. They continue to extend them in some states. But it's crazy. But when you take everything as a whole, guys, we have a market with favorable bullish conditions. We do. And I'm not going to say, but in a year from now, all this shit's going to hit the, right? We always have to say that. But I'm not using a but this time. There's no but. Was I concerned about inflation? Yes, because nobody was talking about inflation. Now everyone's talking about inflation. It's on the table. That was my argument when we saw the China tariffs. It was on the table. Everybody talking about, oh, we're going to go to war with China. It's a big trade war. It is crazy. Every single dip. I said, buy. This is all bullshit. Smoke and mirrors, all these, whether it's China or the U.S. talking their book behind the scenes, they're going to make it work. China's the biggest growth engine in the world, and the U.S. is the richest nation in the world. They're going to get together unless they both want to just crash their economies. They just got to figure out behind the scenes what they're going to give each other, shit that we don't know about. Pretty simple. I mean, it makes no sense for them not to get along. It makes no sense for them to not find some kind of middle ground, but the tariffs amount to nothing. 10 billion, 20 billion, 30 billion here is nothing in the scope of things when you talk about trade. It's nothing. And what happened? Stock market kept going higher and higher and higher. Now, I will say going forward, you're not going to be able to buy anything and make money like you did around a year from now, right? When we started to bounce back. Actually, we started bouncing back around March, April. You could have bought anything and you're doing well. I mean, you see small caps are getting hit with those inflationary concerns because, not all companies have pricing power. Look at Clorox's numbers. Interesting. Not everyone's going to be immune to the chip shortage. Texas Instruments, Caterpillar, Netgear. So you see rising costs are going to smash margins for some companies. But overall, expect growth to continue to work. Netflix, AMD, look at the numbers they put up. The major tech companies, FANG names, are going to continue to grind higher. You kidding me? Running the world, just huge profits, incredible pricing power, great balance sheets, investing in all kinds of new technologies, everything. The reopened names that have yet to hit pre-COVID highs, even names that are taking a hit this week because there's a couple places that are deciding to go crazy with Delta and oh my God, everyone's going to die. I got the vaccine, you're perfectly fine, but we're going to close everything and everyone else should get the vaccine. I'm so concerned about everyone else getting the vaccine. Even though I got it, I'm safe. I need everyone else to have the vaccine. You just need to have it. It's fucking crazy when you think about it. It really is. But the reopened names, look at the airlines. Look at Boeing. Boeing put up some great numbers. Those orders aren't going to come in for MAX planes? Of course they are. As soon as they get the approval, they got the approval basically in the U.S. They're going to get it in China and Europe pretty soon. And these are planes that provide massive margins. 30% efficient, less fuel usage, lighter weight, massive profits for these major airlines that have to upgrade their fleets. It's got to happen. And Boeing's one of the only games in town. The MAX is the best plane in the world in the market. Airbus is trying with that Neo, but not as good. Not as good. There's a reason why a lot of those orders didn't transfer over to Neos, like you would see. They're waiting for the MAX. Airlines still off pre-COVID highs. Even some travel-related stocks off pre-COVID highs. I'm not talking about buying, just, lumping them all together and saying, buy the cruises. No, I know a lot of people have been on cruises, but be careful. These things are trading higher, and again, 35-40%, I think, capacity right now for these guys. And they're trading at higher levels on enterprise value when assuming their debt than they were pre-COVID. That doesn't make sense to me. And we're closing a few places now, which is why they getting hit a little bit this week. Infrastructure names. We know that new bill is going to be announced, however they push it through. A lot of companies are going to benefit from that. Also, what I'm looking at, small cap names that have gotten hit along with that sector for no reason, other than we're part of the Russell, we're small cap stock, we're selling off due to inflationary concerns. There's a lot of names hitting my radar now. These are small cap stocks down 25% from their highs. You're not hearing a lot about that because the market's overall in near all-time highs because it's made up of massive companies where the FANG companies, what is it? I think it's 19% of the S&P 500 now. If those are hitting highs or close to highs, that's going to continue to drive the market higher. The bigger names. But a lot of small names have gotten hit. But when you look underneath the hood, they're still growing like a weed. business models perfectly intact, great management teams. Seen a lot of these names come on my list. Expect those recommendations. And Curzio venture opportunity going forward, and a lot of new recommendations in those areas I said from Curzio Research Advisory. But I know, guys, it's tough to be bullish. It's not the cool thing to be bullish. I get it. I'm out there. I know. Especially since a lot of us, almost all of us, have friends that are struggling. I have several friends, 2, 3 of them, who are in pretty bad shape because they had businesses that were closed due to COVID, because they had few employees. They weren't able to get any of the PPP loans, that are struggling. There's people out there. We all know. So it's tough to say, hey, I'm bullish and things are good. But things on the corporate level, if you're looking at profits, you look across the board, interest rates where they are, holy cow. Lots and lots of bullish conditions and lots of skeptics, which you need to have for the bull market to continue to go higher. You need people to be worried. They're worried. They're not going to put all their money into the market. They're going to constantly talk about the risks of the marketplace. That's what you need. It's when everyone's on one side saying, hey, the market's going to surge. We're going to continue to grind higher and higher and higher. That's when you have to worry. That's when you have to worry. Because markets, and I said it earlier, they never, ever crash when everyone expects it. They crash when nobody expects it. Nobody sees it coming. It's usually caused by something you're not reading in mainstream media. So talking about sectors that I like going forward. And that includes one sector, which definitely going to benefit from more money printing ahead, low interest rates forever. Gold. I've never seen the conditions more ripe to own gold in your portfolio. Don't own 50% of it. Don't put 50% of your portfolio in it. But you should have a good allocation, maybe 5 to 10% into gold. And margins are incredible. The industry is ripe in terms of supply and demand. And you're going to hear a lot about that now because the person I'm interviewing today, this legend, is arguably one of the smartest names in the entire resource industry. He's been at this for 30 years, holding executive positions in some of the largest mining companies in the world. His name is David Garofalo, who's now the CEO and president of Gold Royalty. So David is the former CEO of Goldcorp, which is one of the largest gold mining companies in the world. He was instrumental in this sale to Newmont, which created the largest in the world together. He was the CFO of Agnico Eagle, another massive company, named Mining Person of the Year. I mean, he's got all these awards. Amazing. I thought I was going to talk to him. He'd have this, stuck-up attitude, and I'm great, because he's checked off all the boxes, and I've been around executives like that have half the resume this guy has and are very, very cocky and arrogant, and I like that. That's not a bad quality in a CEO, but David is just a regular guy. I mean, this is going to be an awesome interview. He's going to talk about gold, where he thinks it's headed, and it's not this fluff forecast. All right, this guy from gold thinks it's going to surge. And he provides a lot of great data behind his forecasts. He also breaks down the most important segment within the gold industry that everyone should own. And they should own it for today and for the long term. And it's for reasons that even caught me by surprise. And you'll hear it during the interview. So let's get to that interview. The one and only David Garofalo right now. So David, thanks so much for joining us on Wall Street Unplugged.
Good morning. Thank you for having me on.
So I want to start here because we've got so much to go into with Gold Royalty, you're the chair and CEO, but you've been doing this for a long time, right? You almost your entire career, 30 plus years. I want to talk about the gold market and where you see gold prices, because no matter what stock you're running or what company you're running, a lot is dependent on gold prices. And you would think today, where quantitative easing every place, inflation really, even at the metric that the Fed created to show no inflation, which is CPI, it is at 5%. It's supposed to be, 2%. We know that the inflation is not transitory. We know the Fed is definitely going to keep rates low forever. But yet we're not really seeing that movement in gold stocks. So should we be looking at that as an indicator, or is it, hey, it's all really about the dollar inverse relationship? But how do you see gold? Because right now, for me, we should be well over 2,000, but we're not.
Yeah, look, I think some of the hesitancy around gold is the fact that general equity markets are still quite buoyant, and quite often gold is invested in an asset class in a volatile equity market. So the equity markets have been going in one direction up to this point, but I would say the valuations in the general equity markets have been stretched beyond recognition. A correction is inevitable there. And in the face of quantitative easing, debasement of paper currencies, low interest rates, you have to look at ways to protect your capital, and you should have a significant portion of your portfolio invested in gold. And when you look at gold as an asset class, if you buy into that investment thesis about gold as an asset class, there's various ways for you to play it. You can buy the physical quite readily. You can line up at a bank with your identification, pick it up, and find a way to store it and incur the storage costs. You can buy the gold equities, and of course, what that provides you is leverage to the gold price and leverage to exploration success. But it also exposes you to inflation risk in operating capital costs. You could own the ETF, which is physically backed by gold. That's another way, and achieve economies of scale in your storage costs because you're buying part of a pooled fund. And then finally, what I would say is you could buy the royalty vehicles, which provide you, I think, the best of all worlds, which is leverage of the gold price, leverage to exploration success because the royalties are on the individual properties. And to the extent they are drilled out and grown geologically, you'll get that upside exposure. But what you're insulated from is operating capital cost inflation. And Frank, my argument is right now, we're headed into an inflationary cycle in the mining business as well. We saw this 10 years ago when we saw both base and precious metal companies start to invest significantly in new mine capacity. And because of the downward trajectory in reserves over the last 6 or 7 years in the gold business in particular, that cycle of reinvestment is going to start happening again against the backdrop of inflation in the general economy. And so I do expect there's going to be significant inflation. I think that's some of the hesitancy that investors are experiencing when they're looking at gold mining equities. And so I think the best way to play the gold rally, which is inevitable, we're going to see $3,000 an ounce plus gold. You'll want to buy into the royalty vehicles, in my view, to get the best of all.
Now, for me, and I don't have the experience you have in this industry, right? You're an industry legend. I would argue right now it's one of the best conditions I've ever seen for gold, at least the past 10 years. Would you argue even longer? Because you just mentioned, I'm not even talking about the current conditions with quantitative easing, everything's out of control. We're throwing around trillions like it's nothing. I mean, TARP was 480 million, right? And that was to save the entire banking system. We're throwing trillions out like nothing, more infrastructure coming. So again, we're seeing massive inflation. The Fed has to say transitory because if they don't, they have to be raising rates right now. And that's going to force a recession, which is probably also going to be gold as a safe haven could be a good spot. But also what you mentioned just now is, the reserves where, being in the majors and being involved in the majors, just the amount of spending that took place, a lot of these companies had to deleverage, which resulted in, less reserve, less drilling. For me, it seems like I've never seen conditions like this where people should own gold, but, you've been doing this for 30 years, lived through tons of boom and bust cycles. I'd like to get your opinion on that.
Well, look, I think you correctly pointed out there has been a diminution of reserves in the gold business because the industry has been focused on deleveraging. There was quite a party 10 years ago when gold and base metals were rallying dramatically post the credit crisis, and base and precious metal companies were building new mines, and that inflated costs dramatically, operating capital costs, and undermined that leverage proposition that investors were looking for as the gold price went up. And gold equities and base metal equities underperformed their underlying commodities. And so they, rightfully spent the last half a dozen years harvesting what they built and getting good returns on that invested capital, returning capital to shareholders, and deleveraging effectively to net zero debt. Mining business is at net zero debt, which is remarkable. That's actually inefficient from a capitalization standpoint, but they overcompensated for the amount of debt they strapped on to build that new capacity 10 years ago, and they returned capital to shareholders. And so they don't have a very efficient balance sheet right now, though they are substantially deleveraged. They're well cashed up. And so they're going to have to put that capital to work in the ground, because what we've seen is a 40% decline in gold reserves over the last 7 years from peak reserves. Inevitably, that'll lead to diminishing gold production. And that's likely to stay in place for at least 8 to 10 years because, from discovery to first production and any new gold deposit, you're looking at 10, 15, sometimes 20 years. So we're not going to see a reversal in that downward trajectory in production for the foreseeable future. But the industry has to replace their depleting reserves. And again, that's happening on the base metal side as well. And given the robust demand we're seeing for copper and other base metals as we look to decarbonize the economy, because we need those metals to decarbonize. We're going to see significant investment in new mine capacity and a significant inflation in both capital and operating costs. So again, the way to play gold, in my view, is either owning the physical or owning gold royalties that provides you, again, physical exposure, but also the upside to the exploration that the underlying operators achieve through the reinvestment in the ground in new exploration targets.
So you are the former presidency of Goldcorp, right? You helped with the merger with Newmont in 2019. I think you were there for 3 years. Over the past 30 years, numerous executive positions. I would think after this merger, you could have done two things. One, you could have just retired, or two, I'm sure your phone was ringing off the hook with offers, and yet you go to, relatively a startup, which is Gold Royalty. What did you see in that company to say, hey, you know what, some people love the startup atmosphere, and you've been on the other end of the spectrum with running a very large company and say, hey, I love that startup, and there's a lot of excitement and a difficulty in bringing that to market. But what were some of the things that you saw that for someone who could have took a job, I think, almost anywhere, for you to go to Gold Royalty, I think that was such a huge story.
Well, it's kind of you to say, and I've spent the last 30 plus years in operating roles. I ran Goldcorp for 3.5 years. I ran Hudbay Minerals, a base metal company, for 6 years before that. Was with Agnico Eagle for 12 years. So I've spent 30 plus years in building mines and been involved in the construction of 15 mines across the world and operated countless more of those. So I have come from an operating perspective. And what I've done is made a macro call about where we need to be at this point in the gold rally. I think we're going to have a sustained gold rally for a number of years, given, as you correctly pointed out, the need for governments to continue to print money and keep interest rates low. But I think where we want to be positioned, and where I wanted to be positioned, is at the development end of the spectrum. And because of the significant underinvestment we've seen in both base and precious metal companies into new mine capacity over the last half a dozen years, I recognize the need for companies to build mines again. But I didn't want to be exposed to what I think is going to be an inflationary cycle in mine input costs. And what I wanted to be is at the end of the spectrum that provides capital to the mine builders, developers, emerging producers. And really, that's what royalty companies have done in past cycles. They've acted as the dedicated bank to mine developers. And what I've tried to do in assembling the team that we have at Gold Royalty is put together a team that has operating expertise, not just financial expertise. If you look at the board and management that we've assembled, collectively, we have over 300 years of experience in mine operations and development. And I want to emphasize that, mine operations and development. A lot of other royalty companies are being run by people that have done nothing but build spreadsheets their entire lives. They've never built mines. This group, this management and board, has built mines, countless mines. So they have that kind of expertise, which serves two purposes. One, it gives us a clear-eyed view of and perspective on the underlying risks of the mines that we're financing. So we do, I think, extensive due diligence, and we're in a good position to do that because we've been in their shoes. We've been builders and operators. But also it gives us access. Having people with this kind of tenure in the mining business gives access to royalty opportunities that might not be available to the general market. We don't want to get involved in auction processes where royalty opportunities are bid up to astronomical levels, which undermines the rate of return proposition. So, like the deal we announced last week with Monarch, where we picked up royalties in the Abitibi region in Quebec, one of the most prolific gold districts in the world, that was a bilateral discussion through a relationship we had. I worked in the Abitibi for many years when I was the CFO at Agnico, so it gave me access to people that I knew there, and I got in front of royalty opportunities before they were available to the marketplace. And so we're allocating that capital, expecting to get double-digit rates of return as a result. So, again, the macro call is get involved at the development end of the cycle. That's where the action is going to be. That's the macro call. But in doing so, make sure that your shareholders are not exposed to the underlying inflation risk and input costs on the mining side, which I think is inevitable. And what I liked about the Gold Royalty portfolio is it had a significant mineral endowment. We had 18 royalties with an underlying reserve and resource position of over 32 million ounces of gold equivalent across the Americas in low political risk jurisdictions. That's a great foundational element to build your royalty business from. And that's how Wheaton Precious Metals was founded 15 years ago when it was spun out of my former employer, Goldcorp. It had royalties and a collection of Goldcorp's assets that provided the foundation from which it diversified and grew into what's now the second biggest royalty and streaming company by market cap in the world. And it's not a coincidence that Ian Telfer, who founded Wheaton Precious Metals and founded Goldcorp, is now the chairman of my advisory board. He brings that expertise, that institutional memory. He pioneered the whole streaming model, and we've got him on board. So it's not only important to have that foundational element of reserves and resources that we inherited in the spin-out from Gold Mining Inc., but having the right people that have done this before and have the mine operating expertise, the expertise in founding large cap mining companies on our board is, I think, a significant competitive advantage relative to our peers in the royalty space.
Yeah, that's pretty cool. I don't think there's too many people that could say that. I don't know if I'm saying this correctly. If you're the boss of Ian Telfer or telling him what to do, but that means you're pretty high up there.
We're peers. We're peers. I would never call him my supporter for sure. He's eminence grise of the mining business, and we are super lucky to have him. Not only as chair of the advisory board, he's one of the founding shareholders of Gold Royalty Corp as well. He was a significant investor in our IPO and our pre-IPO round of financing as well. So he's put skin in the game here.
And you talked about it briefly, and I love the inflation argument because you really don't hear that cost and inflationary environment within the cost structure of why royalties are better to own right now, right? You hear, well, you always hear, low risk of development, almost no risk of development. You just lower capital costs in terms of, a few people running it. It's more like a finance company. But just for seeing that, which is definitely happening right now, which is the massive amount of costs that go into mining and that inflation and being immune to that through this, that's a great argument, right? So it's such a great argument that you're seeing a lot of competition in this space. Is it difficult to find good royalties, good projects where you have the majors? And I felt like the streaming companies did a great job when the majors were kind of, I wouldn't say in trouble, but they were deleveraging and, trying to raise capital. And I know they've given away some of those projects, which was easy. Now they're fully capitalized, like you said, no net debt. It's incredible how strong these companies are. And then you have other companies forcing their way into the space, specifically in gold and royalties. How difficult is that environment, and how much does it help to have a person with your credibility, Intel, for you have that advisory board, when I'm sure if you're calling someone, they're going to always pick up the phone for you?
Yeah, look, I think that is a tremendous competitive advantage. And you're right, there has been a proliferation of new royalty entrants in the space over the last couple of years, recognizing that the juniors and emerging producers who've had difficulty accessing capital need a means to do that. And the royalty and streaming companies are trying to provide that means. There's been too many of them that have been introduced into the space. There's going to be a rationalization, a merger and acquisition cycle that's likely to happen over the next year or two. And we're leading the way. We announced our merger with Ely Royalties a number of weeks and months ago, which we hope to close later in August. And that will more than double our market cap and increase our royalty portfolio fivefold, from 18 royalties to over 100 royalties. And now with the acquisition of Marduk, we're going to be at about 106, 107 royalties on a pro forma basis, which puts us at the leader as a leader of the pack post the merger with Ely. So we've started the music. It's musical chairs now. We saw rationalization and merger activity in the royalty and streaming space about 6-7 years ago, when we last had a cycle of new entrants into the space. Now we're going to see that rationalization again, because the name of the game is to lower our cost of capital, because effectively we're acting as a bank for the emerging producers and developers in the space. So it's important to maintain our competitiveness by having low cost of capital. And the way to get low cost of capital is to get a re-rate. Get big enough so you attract more traditional institutional investors into the name. That drives up our multiple, drives down our cost of capital, makes us more competitive as we bid on new royalty opportunities to supplement what's already a very impressive portfolio of royalties and streams.
Pretty obvious here, and this question could be obvious to you and me, but let's talk to everybody else out there who may be a little bit familiar with royalty companies, because when I look at the cash that you have on your balance sheet, and I don't know if it's updated because I know you guys just did a deal, which is $58 million. I don't know if that's included in your deal that you've done only a few days ago. I think this presentation might be, a little bit older than that. But when you look at this chart here and having this amount of money, I mean, the leverage that you guys have to really get into deals, to really sit down. Now you have, great management team, credible, everyone knows you throughout the industry. You're sitting down. They know you have cash. Explain the importance of that. I know that's a simple question for you and I, but people out there, you have to, when you look at royalty companies, I mean, the balance sheet is just as important as the current royalty streams.
Yeah, we have no debt. That's the other thing I would add is we have the largest cash balance. In fact, today our cash balance is closer to $90 million US. And after the Ely merger, some of that cash will go towards completing the Ely merger, and we'll end up somewhere between $30 and $60 million in cash pro forma, depending on what Ely shareholders elect in terms of receiving cash or stock. They have an election to do a combination thereof, or all cash, all stock. It's up to them. So we're still going to be extremely well capitalized even after the merger, and we're going to have cash flow. We're going to have 4 cash flowing royalties today. By next year, that will more than double. Our trajectory in terms of cash flow, we'll see our cash flow increase 5 to 6-fold over the next 5 years. And so we will have access to cash flow, no debt, and very little in terms of G&A costs. Our business is eminently scalable. I'm going to have, after the Ely merger, 6 full-time employees. I could run a business 10 times the size of the one we're going to have post the Ely merger with the same employee base. So every dollar we add in terms of our royalty revenues is going to go right to the bottom line for our shareholders. So not only will it give us the ammunition to do more royalties and compound returns, but over time, we think we're going to be in a position to introduce a dividend.
That would be incredible. People love dividends. Even if it's like a 1% dividend, people just love it, right? It's kind of crazy, especially because
it shows that your business is sustainable. And that's what we have, is a sustainable business model.
And let's talk about that. In the future, what you plan to do. But I think you have royalties in 5 countries right now. Are you limited to the countries, or it's like, hey, we're going to go anywhere we think we can get a good deal? And of course, I know, especially you would know, some of these areas you probably avoid at all costs with their governments. But are you limited to that? And what are some areas you may be looking to explore? And because there seems to be a lot of projects out there. But again, like I mentioned earlier, there is some competition. I'm sure other people looking at those as well.
Yeah, look, what we have, I think, which distinguishes us from a lot of the royalty companies, is extremely low political risk. We're even after the Ely merger and with the Monarch acquisition, which we announced earlier this week, we are 100% in the Americas and low political risk jurisdictions, and more importantly, jurisdictions that welcome mining, that have a rational regulatory framework for mining. We have strong geological models underlying our royalties, big resources, significant mineral endowments. And so when we're looking at other opportunities to continue to diversify our portfolio, we're focused first on the geological model. We want a strong deposit with significant exploration upside. That's what really provides leverage for our shareholders as they look at investing in us. But we also want to be in countries that have a rational regulatory framework, that welcome natural resource development. And we want to invest also in operating teams that have a track record of developing mines in those jurisdictions. So you may see more diversity, geographical diversity going forward, but I can assure you that low political risk will still be a key criteria for us in any investment we make.
And last question here, which is the most important by far. So do you determine where you're going to buy these royalties based on how the cycling is in these areas? Somebody told me about you being very, very into cycling. You go everywhere around the world. So yes, I had to bring that up. So
yeah, it would be helpful, but I promise investors that I won't make it a key criteria. I think there are more important criteria than where the best mountains are for cycling.
No, that sounds great. Well, David, thank you so much for coming on. I mean, you're a big name in this industry. I think, with Mirdani, very lucky to have you, Chair, CEO of Go Royalty, and feel free to come on whenever you want to update portfolio. Seems like you guys are in great position, and wish you guys the best of luck.
Well, I have to say, I'm lucky to have Amir as a partner, because he had the vision to found gold mining 10 years ago, buying at the bottom of the cycle. And that's what underlied our royalty portfolio. If he hadn't accumulated those assets at the bottom of the cycle, I wouldn't be in the position I am today to create the royalty vehicle we have. So I'm lucky to be a partner with him, believe me.
No, well said, well said. Well, thank you so much for coming on. Hopefully you join us again soon.
All right, thank you.
Hey guys, great interview, David. Like I said, he's a regular guy, right? I like messing around with him, Ian Telfer. But you would think like, hey, you tell me a guy it's not really a big shot. He is. He's one of the biggest names in the industry. Gold Royalty, great job getting him. Ian Telfer, just amazing people that board of directors and advisors and stuff. But the royalty argument, okay, I've covered royalty companies all the time. Yes, you don't have the risk of high production costs and all this stuff. And then more like finance companies, you keep costs low and that was always there. And then these things started trading at a huge premium to everybody else, right? Especially over the past 4 or 5 years as gold started rebounding. But when he said owning royalty companies is a way to avoid the inflation costs, the massive inflation costs that gold companies are going to see just like everyone else. I mean, you talk about labor, equipment, tires. I mean, the commodity costs are huge, especially for that business, right? I mean, it's so capital intensive. And that made a lot of sense to me. I was like, well, I didn't really think of it that way. Like, hey, you want inflation hedge. Yes, of course, you want to buy gold companies. But really, the inflation costs that they're going to see within that industry, especially if gold prices don't go a lot higher, right? They've been kind of around the same price for a while now, a couple of years, up a little bit over 19, down to 17, 1800, whatever. But, now you're going to see profits go down if their costs go higher. So how do you avoid that risk is these royalty companies. And these guys are set up where at the beginning it's like, royalty coming. Now they got, royalties coming in. You have the Ian Telfers and David calling you up with a huge balance sheet. I mean, you're going to take that call no matter who you are in the industry, no matter who you are. I don't care who you are, whatever. But that's amazing. So they're set up, great position. They continue to expand by more and more royalties. But that's a company in great position. I love that interview. World-class management team, and has tons and tons of potential. So much so, I am an investor in this company where I invested at a secondary offering around this price. But I have a pretty good position in this company. This is something I believe in, something I'm not selling anytime soon. And I'm glad to hear from David. And I'm glad you heard from David. So, again, every company has risks. This is a company I'm invested in around this price. I also got warrants because I invested, being a credit investor and stuff. But this is something I plan on holding on long term, and I love everything that's going on with this company right now. But again, do your due diligence. There's risks in every name, and like I say all the time, this podcast is about you, not about me. So let me know what you thought about that interview. You can email me, frank@curzioresearch.com. That's frank@curzioresearch.com. Now let's bring in Daniel Creech, because there's a lot going on. What's going on, Daniel? How's everything?
Frank, what's happening?
So, I think the biggest story right now,
oh boy,
has to be the Delta variant. I didn't think it would be a big deal. Companies are saying it's not a big deal. Even those companies on the far left, Coca-Colas and stuff, are like, we're not seeing anything from Delta, any less spending or whatever. However, we have states going crazy right now. Mask mandates back in place in some places. De Blasio, who's, man, that freaking guy. That guy's done everything in his power. He's done such a fantastic job destroying New York City. I mean, it's been perfect how he destroyed New York City, and he continues to do so. It's so fantastic. I don't know how any idiot in New York could vote for that guy. I don't care, Democrat or Republican. I have no idea how you'd support his policies by going to New York City right now and saying it's not the shittiest place. It's 10 times worse than it's been in the last 35, 40 years. I don't know how you can go to New York City and not say that. And he just continues to make it worse. I have no idea who supports this guy. I have no idea. But it's personal to me. Anyway, he's mandating, I think it's the first place in the, maybe not the world, but the United States, but I think I read in the world that mandating that you have to provide proof that you got vaccinated and your passport in order to go to indoor places, which is fucking insane, I think. Anyway, I want to get your thoughts on that, because the reason why we're talking about it is not even your personal opinion, whatever. It's impacting stocks. We're seeing cruise companies get nailed, on this news, more closures, and who knows if we'll go to lockdowns. I have no idea, but it is seeing an impact in a lot of stocks.
Yeah, absolutely. The scariest thing there, outside of the New York City rant, is this is the biggest risk to markets, period. The government can change and does change rules, moves the goalpost, et cetera, et cetera. And just one small caveat there, Frank, the Delta is not the biggest story, just like the coronavirus wasn't the biggest story. It's the reaction to and the enforcement that's the biggest story. And that's really what's scary, because you have no power and control. That's a very humbling thing to think about. I'm an optimistic guy. I'm not worried about the markets right now. However, one day doesn't make everything. There's a good country song called One in a Row. which is hilarious. But that's not the way you invest in markets. So you look at this today, you got headlines saying, hey, Shake Shack's down 5-6%, along with other restaurant brands, because this big deal, if you have to show proof of vaccination to be a customer, there's no way that this divisiveness and divide is, A, not done on purpose because you're choosing to enforce something when you don't have to, and B, there's no way this doesn't affect margins, customer bases, revenues, all types of things going forward. You just have to figure out, okay, how crazy is this going to get? It's going to get a lot crazier, spoiler alert. And, how long does it take for pollution to flow downriver and get to everybody else? So unfortunately, these are the dog days of summer, Frank. This is a boring time. We have some good earnings. We could BS about that. But there's really not a whole lot going on outside of government overreach, which has been the same story for over a year now. So that's kind of depressing. We got to entertain people somehow else today.
I'm going to entertain him, but did you just quote a country song? That's pretty cool. People don't know how much you love country, right?
I love country music. Old country music, too. Not that the new stuff's kind of tough to take, but yeah.
Who's your favorite artist of all time?
Oh, that's an impossible question. I don't know that one. Everybody from like Waylon Jennings and George Jones, the old school, to like Toby Keith has a good sound. He's not new, obviously, but he's one of the best out there. Yeah, I like those guys that sound old school and country. The people that have fiddles, steel guitars.
Cool.
Not most of the stuff on radio today.
I think you just got some more fans of people who
well, demographically, I'm our best.
Being conservative, they're like, wait, but he likes country, so okay, I'll give him half. They like you like 12%.
I like classic rock too. I'm a huge Eagles fan. I cried when Glenn Frey died, as millions of others probably did.
Yeah, no, classic rock. Oh, it's awesome. But anyway, getting back to the CDC, which I love because the CDC, nobody knows what's going on, and I got to tell you, I think this is something that for the first time in a long time, Democrats and Republicans are coming together on this.
Wrong.
They're pissed. No, they are. They have no freaking idea what's going on because CDC is not being clear. Like, okay, you can't go indoors unless you're vaccinated. How do you know if you're vaccinated? We don't. We're not going to know. Okay, great. So you have to wear masks when you go to restaurants, but you're allowed to take them off when you sit down again. Okay, that makes sense. It's all the communication coming out there. Even from Rochelle Walensky, who's a director, who I can't see her being there longer than a couple of weeks. They got to get her out of there right away. I mean, she's a disaster. Obviously, there's someone pulling her strings, and you see it a mile away. But she went on TV, I think it was 3-4 days ago. I was watching her, and she said this is the push for everybody to get the vaccine. You need to get the vaccine no matter what. But they were talking about kids from 5 to 11 and why it's so important that we get this past the date to 5 to 11 years old. Daniel, 5 to 11 years old, right? That's where my kids are in. My oldest 13. But 5 to 11. So she said... And she said this right on TV, anyone could see it, that kids in that age group die more from COVID than the flu. That's what she said. That's an absolute lie. That's a lie. And you know on what stats that's based on? The CDC. So if you look at the CDC, it shows a little over 500 kids died from the flu last year. And then you're looking at around 300, less than 300. Died from COVID, and they were saying out of those 300, 25% of them are probably like not even accurate because most of them have underlying conditions, and it was the same condition. I forgot what it was. It wasn't like pneumonia or whatever, but it was a condition that some of the kids had that they couldn't really identify if it was really from COVID or whatever. But if you are actually lying about your own statistics on TV, how could anyone trust what you're going to say? Because if there's science behind it, that's fine. Give us the science. Right now, for me, I'm not vaccinated. And I'm not vaccinated. I believe in the vaccine. My mom has it. I think if you have underlying conditions, you're crazy not to get it. I think you should get it, especially if you have underlying conditions and you're over, I would say, 55, from someone that's researched this to death. For me, I have antibodies. I had COVID already. And there's no science behind it other than the CDC telling me, Daniel, that we don't know how long those antibodies will last, even though they've lasted for longer than people that have the vaccine since you want to provide a booster shot. So why am I going to inject myself with 10x antibodies when I already have them, right? It's a good question. It's not like I'm against it. I'm not like pissed off and whatever, but the fact that I have someone telling me, F you have to take this vaccine no matter what, or you're not going to be able to do this, this, and this. I'm talking about places out of Florida and Texas, right? Because that's how it's going to be in New York, California, San Francisco, masks. You're going to have to, and the CDC said, well, we're looking into it, even though they don't have the authority. Well, we're looking into mandating vaccines. Holy shit. I mean, which country do we live in? But that's, I think from what I'm hearing, what I'm reading, Daniel, on both sides, Democrats, Republicans, they believe a lot of this is all bullshit and none of them believe it because they're not seeing the science behind it. The CDC is all over the place. Nobody knows what the hell's going on. I don't know. I don't know how this is going to turn up. I do know if you're going to get to the point where you're forcing vaccinations and we have lockdowns, you're already providing some areas with mask mandates, you're going to see chaos. I really believe that. You're going to see chaos.
Yeah,
people
I mean,
are
absolutely.
dying to get, people do not want to go back to that again. No way.
No, and rightfully so. I mean, the mental health effects, the physical health effects, all that kind of stuff, suicide rates. It's sad stuff, and you can't rewind the clock. You can't go back. But yeah, just knowing that stuff is still back on the table should scare everybody. And like I said, I'm an optimist. I hate to kind of project fear on that side, but you have to pay attention to what's going on. In the investing way, or the way to deal with this through investing is to keep buying the big guys, because you're not going to have more enforcement and more control and also have prosperity spread across a large group. So, just like the FANGs and the Amazons and the big conglomerates did so well during COVID, that'll be the exact same thing going forward, depending on, and again, we're kind of in this waiting mode here of summertime because there's a lot of scariness coming on. There's these headlines of, hey, what if they do, think about the test just to people's investors, optimist. If you come out and think about more lockdowns or more travel restrictions, everybody's naturally going to go, okay, there's a volatility. You'll probably see some sell-off in stocks. But then what are we trained to think, just like hamsters, Frank? Oh, well, the Fed's going to come and print more money and more PPP loans and more stimulus checks, so everything's fine. It worked last March. Look at record highs stock market. So that's the scary thing, because people are already conditioned to. Wall Street's already hooked on easy money with QE and the fear of talking about tapering and all that. It's getting harder and harder to hide all the clowns in the circus, Frank. So, I'm trying to provide value here because this is a tough waiting scenario, but keep buying Facebook, keep buying Google's, watch what politicians do, not what they tell you. And another big conglomerate's an easy one is Blackstone. Oh my goodness. I think they're the largest owner of residential real estate now in the U.S. Mm-hmm. I think I read that right. Been a fan of that stock for a while. No credit deserved. I do not have it. I have not recommended it. But I've been following that, and it's hard not to jump on the conglomerate bandwagon as we continue going down this tide of the government's just pushing everybody and kind of herding us to sheep, Frank.
I could see with Delta if it's causing more deaths. If we see that, hey, this is causing more deaths, it's extremely dangerous. I could see that. I think anyone would say, okay, we have to be careful. But it's not, right? It's not. We all know that. It's milder than the original strand. Then they're saying, well, we're going to provide mask mandates for the areas that, and this is CDC, that the areas, are most exposed to this, or we're seeing the most cases. And which areas of that? Well, we don't know. I mean, some areas that they were saying, there was like 2 deaths in the area the past month, and they're like, okay, well, that's one of the areas that needs masks. There's just nothing behind it where it's like, okay, if this happens, this happens. No, it's all like, okay, we think we should do this, we think we should do that. And you know what? It does result in a lot of crazy movements in stocks. Where we're seeing, a lot of those names, the reopen trade names, get crushed. Cruises are getting crushed. I mean, I think this is kind of surprised that we're seeing mask mandates again. I think that's a surprise to the market. I think people were like, no way, we're not going to see them. And now, with de Blasio in New York saying, indoors we need to see, a passport, you being vaccinated is absolutely insane. But if we really see that in some areas, holy cow! I mean, you're going to see a migration even more crazy now than to Texas, Florida, and stuff like that. But more to the point here is the stocks that are getting impacted, I would use as buying opportunities. I mean, look, the politicians are trying to squeeze the most out of this for power. They're trying to squeeze the most out of this, right? That's why no one's talking about Delta and deaths, which is the end all. We should be talking about the death rate. That's what's important, people dying, right? But we're not seeing that from Delta. We're not seeing that at all. Very, very, very few. Why they don't disclose that, I have no idea why they don't disclose that. Why don't they disclose that 90% of people who have got the vaccine will not get affected by Delta? Will there be 10%? Yeah. 90%, over 90%. They won't put that in perspective. They won't say 90%. They just say, hey, these people in Massachusetts had the vaccine and they got affected by. It doesn't happen often. But I don't care the agenda, but when it results in companies listening to them where they're closing places and they're issuing mask mandates, holy cow. I mean, it's getting crazy out there. It's going to result, listen, we're going to open up eventually. People are going to get sick of this bullshit. There's no facts behind it, which we see right now if you're looking at the science. It's going to result in the buying opportunity for a lot of these names, especially, the airlines I was talking about. There's travel-related stocks I'm talking about, but you're going to see these things pull back probably 5-10%. Use it as a buying opportunity because, this is only temporary. They can't go with this story and continue to push this agenda without any facts. And even the fact that it's coming from Democrats now saying, we want to know, like, why we have these mask mandates. Why are you doing this?
You don't think they can keep pushing this for a while? Give me a timeline.
Not
and I'll
a
ruin
timeline,
it for you.
no more than a couple months. I would say 2 months.
Oh, that's easy. I'll take that. I take the over on that.
2 months before you see this mask mandate.
There are no coincidences,
no way.
Frank. This will last until at least the elections next year for the midterms.
I mean, they're searching for stats, and they just can't find them of why they need to do this.
Hey, 2 plays, if you're back on the mask mandate thing, which you make a good point. 3M, ticker MMM, 3M Company. And then, Frank, do you know APT, Alpha Protech?
No.
Mask manufacturer, I guess. Is that how you say it? I've seen that over Twitter. They are out of China, though, I believe. Are they in China? They're headquartered in Canada, I'm sorry. And Alpha Protech, I've heard that. I've seen that come across our briefing signs a few times just as a mask play and things. So a couple of tickers there to look at if you're, to your point, as they go down the mask mandate in several areas. And also if hopefully the next stage on the road down to mandatory vaccines would be testing, because I've seen a lot of headlines about, hey, if you're part of the federal government or work in the federal government, you either, I believe it's either, not one or the other, or not both, but if you don't get vaccinated, you have to submit to regular testing. Did you see that, Frank?
No, I didn't.
Okay. I think that's the case, and I could be totally wrong. However, the point there is testing. So just like Fluidigm was an old friend of ours in CVO, does testing and rapid test, very high accuracy. There's a handful of testing and or vaccine candidates still out there that you could probably play if you want to dive into that space and kind of play on the headlines and the current environment.
No, no. Again, we want to try to provide ways for you guys to find new ideas to play off of it where we all have opinions about what's going on, but no matter what side you're on, you want to make sure you're able to benefit, right? Because you're going to see different stocks move in different directions based on, the news and what's happening. And some of them provide great opportunities to buy some of these names, and some provide great opportunities to really take some profits and get out. So, and that brings us to earnings season. I mean, earnings season has been pretty insane. I don't think I've seen an earnings season like this in my life where so many companies have beat. I think we're near record highs on beat, and the beat is massive. And people say, well, you're comparing it to last year. These are analyst estimates, and they're just destroying the analyst estimates, which means if they're reporting higher profits, that P for SP 500, which was 23, I think, it's only 21 now, right? Because we're seeing a market that's kind of held steady, going a tiny bit higher, but earnings are rising, which is going to lower the overall PE. And it's amazing to see which companies have pricing power and which companies could pass on those costs, because they're all seeing higher costs from commodities. If you look at the housing, I think they have a basket of the commodity index related to housing is up like 35% year over year. And this is as of, I believe, a few weeks ago when lumber already has come down a lot. Still up a ton from its lows, but it's come down a lot from where it was. But passing on these costs, you're seeing which companies could do that and which companies can't right now. I mean, Clorox got nailed. You look at Netgear got nailed. Texas Instruments had a terrible call. But yet you're looking at look at the Under Armours and look at the Nikes. I mean, these are companies, Under Armour, I think, has so much upside potential here. I mean, I really like this name, but it's rare that you see, especially during this earnings season, Dan, that a company has I think it went up 6%, 7% running into that quarter, and then reported earnings, blew out the numbers, and went up another, 5-6%, whatever it was. Usually what you're seeing right now, and this is a stat, guys, the average company that's beating, which is most of them, the average company that's beating on both the top and bottom line is going up only 0.8%. Yet, if you miss and report a weak quarter, you're going down close to 2%.
Yeah.
So if you look at that statistic, think about that. There's still, most of the S&P 500 reported, but if you're buying a stock, just see when it reports. Because even if they blow out the numbers, chances are you're not going to get a huge push higher from that. And if they happen to miss and you read it wrong, you're going to get nailed. So the risk reward of buying a stock into the quarter, it's why in one of our newsletters, I didn't recommend anything, which I recommend a stock every month. I'm like, guys, I'm not going to just throw something at you that's going to be down 20% or has an opportunity to 15% because of one quarter. But that's the market right now. And, Under Armour really killed it. And, that's a name that I think was great this week. But, we saw a lot of other names report, get hit a little bit, and then start coming back. And Square's another one that was $27 billion acquisition. Holy cow, that's a big acquisition for those guys.
Yeah, absolutely. And plus, it was interesting because they're buying that company. I don't have the name of it in front of me, but it's buy now, pay later theme. I don't know if that's more of a loan portfolio kind of a book play, just kind of annuitizing all these type of loans or whatever. I'm sure they're favorable interest rates and all that kind of thing. But just fits with the big picture of this kind of margin / loan / buy now, pay later type deal. But Square's been knocking it out of the park. They have great services. That's been a great winner for CRA. Not in there anymore, but it was a great while it lasted. Clorox, the big thing there. So not only, to your point, you're matching comparables to a week last year, and analyst estimates for the most part, weed that out. But margins for Clorox dropped almost 10 percentage points. That is a massive move for a huge company. And it was because of higher manufacturing and logistics costs. The important thing will be going forward is, are they going to be able to raise prices from here going forward, or are they going to be able to lower prices on the manufacturing and logistics cost to get those margins back? Because there's no way a management team can sit on their hands, for the next quarter and not improve this one way or the other. The low-hanging fruit is probably to assume that manufacturing and logistics costs will continue higher for the next quarter or two, so they got some maneuvering there to do. But obviously, they're an essential business. If they're getting sold off or whatever on a pullback, that's a longer term. I don't think that's a trade. I think that's more of an investment. So keep that in mind when you're looking at these conglomerates. And also, if stimulus money does run out, I know there was an I believe it was Arkansas judge that reinstated the $300 unemployment benefits. So that's going to go through some more legality. But if stimulus does get cut off to a certain extent, that's going to have a ripple effect through pricing power or through the economies, and really see who has pricing power and consumer choices. So lots going on. Like I said, Frank, it's just a boring summer day today.
Yeah, but you know what I do like? I like when I'm seeing, different companies report and how they report and how they're dealing with this cost. Like Ford, I thought was amazing because Ford actually blew out the numbers and everything's great. You know what that's based on? That's based on future orders of their cars. They're doing exactly what Tesla did, where everyone ripped the shit out of Tesla for doing. These are future orders. People putting down a few $100 on the car.
They also raised guidance, though, didn't they?
But expecting that these sales are going to go through, right? Yeah. So you're expecting that. But I have to tell you, and this is a research firm I respect a lot. They're called IHS Markit, MARKIT. Right, so talk about U.S. manufacturing. They say July PMI ticks up to record high, but supply delays and price pressures also hit new peaks. We're under the impression, based on what companies are telling us, that, hey, most of that risk is behind us. I bought a mattress. You probably heard me say this a lot. I bought a mattress. We're going on 5 months ago. And after 3 months, they said it'll be there. They said it was supposed to be there. I think it was 10 weeks. And then, went to 3 months, went to 4 months. They actually gave me free towels and stuff like that. We're going on 5 months. I still don't have that mattress. Okay. What they're saying right now, which these guys cover this great. There's a great research firm. I love Evercore. I cite a lot too. So sharper expansions in output, new orders, and employment. Cost pressure spike amid record shortages and effort to build stocks. Again, those supply delays and price pressures, the supply delays are hitting peaks. They're still not at the bottom yet. We're not seeing like, okay, now it's finally, we're seeing this open up. We're not seeing it open up. And now, guys, we're getting into more floods and stuff like that. If you read the news, if you're looking at into China, right, that's going to hurt shipping. And now we're going into the most important season for tons and tons of companies, which is the holiday season where people spend the most money. And now you talk about massive delays. So you have backlogs at record highs because everyone's booked. Just like they account for my mattress that I purchased already, several $1,000s. I need a great mattress. I got 2 back surgeries, so that's something I pay up for. But you're looking at this company book that, show the backlog. You know what? I'm pretty close to saying, F it, I'm canceling, I'm done. Because I don't know when I'm going to get it. You're going to see the same thing, that a lot of these car orders. Are you going to wait a year to buy an EV when you might be able to get one from Tesla in 3 months? I don't know. Maybe you do, but eventually you want to get a new car, but how long are you going to wait? And some people have leases and they have to. They're forced to buy even earlier. But when you see stuff like this, backlogs rising to record highs, which is, a great thing, right? Business is built up, but you have to deliver. And the fact that it's taking longer and longer to deliver, you're bringing in that risk of these people canceling orders. That's one thing I don't think that's factored into a lot of individual companies, especially Ford. I hope they sell a lot of cars. I covered Ford. I said it was a huge buy. They have some of the best EV technology. I've been saying that for 5 years because I've been going to the Consumer Electronics Show. They spent billions, spent a fortune. They got wrecked doing it. And now people are seeing that. But at this price, at where it is, and the fact that very few cars are being produced, and they're talking their EV portfolio up so much, even though it's a 2030 story, they're saying, oh, we're going to have these cars released soon, a couple of years or whatever. For me, that's bullshit, and I think it's eventually going to hit them. But that's another company that I enjoyed listening, saying, wow, I really don't believe these guys. Like, they're not really talking about they're talking about everything's okay right now, and it really isn't. And that's still a big story. It's still a big story with chip shortage.
Yeah, a lot remains to be seen. I mean, we talked about it a week or so ago. I mean, Taiwan Semi says that the worst of it is going to be, past us, and it's going to improve on the auto sector, and they're increasing production. So, yeah, to your point, you got to execute, you got to deliver. So, who knows if that'll be over the next quarter or the next 2 quarters. But, yeah, unfortunately, our hands are tied, and you just have to see who's telling the truth.
No, I know. And I will say this. We talked about Square really quick. I just want to talk about a couple more companies, guys, which I know you guys love hearing about, is Square. How much did they pay? Was it 27 billion? I believe.
Somewhere. It was 25 to 30. I know it was between that.
And there's a company
all
with market cap
deal, though.
A little over 100 billion. This is a massive purchase. And, I've seen a lot of people, even Schiff came out and said, you overpaid for this. This is crazy. This is a crazy bid. You overpaid for it. The stock went up to the tune where they added $12 billion in market cap because of this deal, and this is an all-stock deal. So it just got a lot cheaper. So just like, if they have that agreed-upon price, which they do. So I don't know when it's closing, but usually it's based on 30 days and what the average price is and whatever, but that's how good that deal was. But when you look at it in that terms, it wasn't such a bad deal. Another stock that I really like on this pullback is Take-Two. This is a company I followed for 15 years in the single digits. And it pushed 200, pretty close to that. It sold off a little bit. It's one of the stocks in our portfolio. It's like 155. It's down 10% after earnings because they said they might delay a few titles. This company always delays titles. It's not a big deal. These titles are going to come out. The new Grand Theft Auto is going to come out. But every time these guys come out with a quarter like this where they beat, but their guidance expectations are always very like, hey, we're not going to meet them or whatever. The stock pullbacks turned out to be a big buying opportunity. And then it was only down 5% after they reported earnings. Again, they beat top bottom line all across the board, except for guidance. They just, conservative, and not even that bad. Just conservative, a little bit delayed titles. Again, those kind of come out. But then in the middle of that day, we saw China come out and say video games are bad. And then
not bad.
Tencent,
they're opioid for the mind.
Yeah, they did. Yeah. So and Tencent got nailed.
My parents got on me a few times about playing too many video games or being a zombie or being a brat or whatever. But I never remember my mom or my dad saying that they were opium for the mind. That's pretty good. I know. Well, you got
like kind of lucky, though. I mean, the video games that we played and the shooting games, I mean, that results in us going around killing innocent people, right? I mean, that's according to what a lot of people think. So we all go there and think it's real life and start running over people like we do in Grand Theft Auto. So, we got lucky that didn't happen to us. Oh, my God. We didn't know any better.
Us. Hey, we didn't grow up together. Come on. What do you mean us?
Well, I mean, yeah, that's true. I'm a little bit older than you. You got a good point there.
I'm kidding. That's funny.
Definitely got a good point there. All right, guys. So listen, we talked about a lot of different stocks. We talked about a lot of different things here. One last thing is, and I don't even know if this is worth speaking because we talked about earnings already here, Daniel, but you're looking at the inflation picture where, I don't think it's so much as a concern, as I said earlier, because everybody's talking about it, but it is a concern for some companies, especially look at Clorox, no pricing power. They didn't have pricing power, and those companies are going to be nailed. Just pay attention, guys, to that quarter. Your company may have blown out the numbers and it pulled back, and you're like, why did it pull back? It's because a lot of those names have ran up into the quarter, which is normal. But you want to look at the underlying trends. Who's hurt from the chip shortage? Is it going to end anytime soon for these guys? It's not impacting Apple, iPhones, and things like that. These guys have leverage with Taiwan Semi and Samsung and the places that produce a lot of this stuff where they outsource almost all this in fab facilities and stuff. But who's got the most leverage? Who does well during that environment? You've seen a lot of companies do great. NVIDIA didn't really impact. AMD, it really didn't impact, but other companies it has. Pay attention to that. Pay attention to the costs. Who's able to pass on those higher costs? If they're able to pass on higher costs, who cares? If commodities and their expenses go up 20% if you could increase your product by 25% or even 47% like Facebook. It's not a big deal. It's not going to hurt them, but it is going to hurt a lot of their small competitors. And that's what you're seeing right now, especially Daniel, the bidding war. And this is what I heard from the inside from some of the great report. I think it's from Maersk in the shipping industry, where the big companies, even like the Amazons or Walmarts or whatever, right, shipping their goods, they're outbidding everyone else to the point where they're losing money to really crush a lot of their competitors. And their competitors, if you're small cap, mid cap, you can't compete with those bids because you can't afford to lose that much money. And it's going to result in a lot of your products not getting to the markets they need to get to, which is, going to result in cancellations and a lot of those sales going over to the big guys, which they'll make up later on. They can afford that. They can afford to lose tens of millions of dollars, billions of dollars over a year when they know, due to what they're doing right now, that's going to result in 3x, 5x the amount of profits because we're going to eliminate almost all the competition, and that's when we can really raise prices. So a lot of that stuff is going on. Pay attention to conference calls. It's not too hard to see it if you're paying attention. I think that's it, Dan. We cover a lot of shit, right?
Yeah. Yeah, there's always a lot of, for a boring summer month, there's going to be plenty. So, yeah, we'll keep you in tune. Don't panic. Don't get too depressed. And, just sift through the noise and enjoy the hot days. And markets will be back here, same time, same place.
Yeah. And if you're impaired, enjoy it because your kid's going to go back to school pretty soon. So enjoy that. That's going to be awesome. This way you can hang out and relax a little bit. I love my kids. And we are going to Universal for a couple of days. We're supposed to have a vacation, but kind of got... I won't get into it, what happened, but instead we're going to just go to Orlando and hang out for a few days with the family right before they go back to school. But enjoy it. Enjoy the weather. Enjoy it with your families. Have fun. Pretty cool. Dan, thanks so much for standing by. Really coming by. Really appreciate it, buddy.
Yeah. Cheers, everyone.
All right, guys. So listen, that's it for me. As you know, we launched our newest product, the Big Money Report, with Luke Downey. It's doing fantastic. Thank you so much for all the support. We still have that sale going on. It's under $100 for the entire year with a money-back guarantee. So if you take a look at it and you hate it, you can come out of it. And again, money-back guarantee, no questions asked. We're not going to force something on you that you don't want, but we know once you do see his research, which you could see for free on our website, curzioresearch.com. It is awesome. It is great. That's why we hired him. That's why we're launching this product, and we're also going to launch more products around him. I'm very excited about that. And thank you so much, guys, because the support for this newsletter, support for Luke. We're seeing really, really strong demand for it. And as we are for most of our products right now. So people are dying for really good research, no BS research. They want to be educated, and that's resulting in a lot of new subscribers coming onto our list, which is really, really great news. So I just wanted to say thank you so much. And if you want to subscribe to Big Money Report or find out more, just go to www.bigmoneyreport.com. That's www.bigmoneyreport.com. Okay, guys, that's it for me. Have a wonderful week. So much for listening. Thank you for all your support. And as always, I'll see you in 7 days. Take care.